Hello, everybody, and welcome to a second video in our series of exploring a balance of payments. In the previous video, what we discovered was that the UK has got a large and genuinely growing current account deficit. And what we said was that countries like the UK, they cover this current account deficit by running a surplus on the capital and financial account. In other words, we have to attract the investment money to come into the economy to cover that current account deficit. What we said was that this could be problematic for our economy, given that this is a long-term trend. This can suggest that our economy lacks international competitiveness. This could lead to a growth in deindustrialization and therefore more structural unemployment. It can also become a problem if you start to struggle to attract the funds in on the capital and financial account to cover this deficit. You've also got the problem this could then lead to the currency becoming weaker over time. What we've therefore got to be considering today is how do we go about tackling a current account deficit? Right, now what we can see here are policies that can be used to tackle a current account deficit. So we're going to be considering expenditure reducing policies, expenditure switching policies, currency depreciation, or what we call a devaluation, and then finally supply side policies. Right, now first of all then, what we're going to be thinking about is that in the UK, British people have a high marginal propensity to import. So when incomes increase, more of us like to go and buy more foreign goods and services. So if you earn more money, you might go and buy a TV. There's a good chance that will be imported into our economy. People might go and buy a new car. Now that might be British made, but there'll be lots of components in that car which will have been imported, engines, etc. So what we could be looking at doing then, if we think that we've got a high marginal propensity to import, we could be looking to policies that will make people poorer, what we call expenditure reducing policies. Now, what we're going to do here is to try to reduce the demand for foreign goods and services by deflating the economy through the use of fiscal and monetary policies. So what we're trying to do is to reduce aggregate demand. Okay, so what we could do, for example, is to raise income tax rates. If we reduce people's disposable income, they're less able to buy foreign goods and services. We could also raise interest rates. That would increase the cost of borrowing, and that would mean that people are having to dedicate more of their funds to paying mortgage repayments potentially. And if that's the case, they've got less disposable income left over to fund imported goods and services. Also, higher interest rates will mean the cost of credit to buy things like new cars will become more expensive, and that would lower the demand further for those foreign goods and services. Now, what this would also do, if we're going to reduce demand for goods and services within our economy, it means that our firms have got to increasingly look to export markets to sell their goods and services. So what that would mean is our firms, rather than focusing on domestic demand, are now suddenly got to focus more on exporting their goods across the world. This policy is that it reduces aggregate demand. So it conflicts clearly with other key macroeconomic targets, such as economic growth. And of course, if it's crippling aggregate demand, then it would also potentially create unemployment as well. So it can be used, but there are some big drawbacks of this policy. A second policy is to use expenditure switching policies. Now, in an earlier video, we did look at how protectionism can be used to reduce demand for foreign goods and services. So tariffs on foreign goods coming into the economy, for example, will raise the price of foreign goods, and that will therefore encourage more people to shift their demand towards more domestic production, which are now technically more competitive than what they were before, and that would in theory lower the demand for foreign goods and services. Of course, this could also be done by domestic subsidies, which will lower the price of domestic goods and services in our economy, and that will hopefully again shift people's demand away from foreign goods towards domestic demand. The problem with this policy, though, again, is all the problems that we explored linked to protectionism. Tariffs raise prices. Well, that could be really bad for people genuine low incomes. It could lead to more relative poverty and exacerbate the inequality problem within our economy. You've also got the risk of retaliation. Tariffs on foreign goods and services will mean that foreign economies are likely to do the same to our goods and services, and that could also reduce export demand as well. A further policy is to weaken the currency. Now, you've got two different words here, devaluation and depreciation. A depreciation is where the currency becomes weaker, and that is through market forces. So it could be driven by lower demand for your currency across the world. It could be driven by an increase in the supply of your currency. Now, when we look at a devaluation, this is where we deliberately intervene or manipulate our currency value downwards. Now, the logic would be if you can deliberately weaken your currency, then what you're doing, you're going to be in effect worsening your terms of trade. You're going to make foreign goods and services more expensive to buy within your economy. Obviously, what you should be thinking about here is WIPI-DEC, weak pound, imports dear, exports cheap. If the currency becomes weaker, then ultimately you are raising the price of buying foreign goods and services. And that will hopefully make domestic goods in effect appear more attractive domestically. But also, if our currency is weaker, the foreign currency price of our goods across the world will become cheaper, and that should incentivize a growth in our exports as well. Obviously, a problem with this, though, is that, again, it raises the price of imports, and that can lead to cost-push inflation in our economy and raise the price of people's living standards. So that could lead to lower economic welfare in society. Another policy, and this one you could argue is a lot more trying to tackle the actual root cause of the problem. What we know is one of the key reasons why the UK has a current account deficit is low international competitiveness. So our prices tend to be higher than what it is to produce goods and services in different countries across the world. So supply side policies are designed to actually tackle the root cause of the problem. It's about raising the competitiveness of our goods across the world. So what we're trying to do here is to make the LRAS curve move outwards, reduce business costs, raise competitiveness of our economy, improve productivity. So things that we could do here, for example, is to cut corporate tax rates. This market-orientated supply-side policy will encourage more investment by firms. It could attract more foreign firms into our economy, who will hopefully bring with them better capital, which can raise productivity. So this would encourage more enterprise in our country, which will increase competition and hopefully drive prices downwards, which will raise the popularity of our exports across the world. We could look at improving infrastructure. So what we could be looking to do is to upgrade our road networks, our other transport links, improve access to communications technology, improve power supplies and reduce costs of power. Improving infrastructure will again raise the competitiveness of our goods across the world. It might even suck in more foreign investment and lead to more enterprise again within our economy. We could also look to improve human capital. If we upgrade the skills and education levels of people in our economy, then again, it means that people become more productive. That should lead to lower costs of production, improve quality of our goods and services, and hopefully fuel the growth in our exports across the world. Promoting competition between firms. Again, it's incentivizing more competition, leads to more productivity improvements and more enterprise, and that will again drive down costs of production. We could also look at removing regulations from markets. That again leads to more competition, it lowers costs, and it allows our firms to be more competitive in international markets. Now, clearly problems of supply side policies are, though, and we've explored these before in the past. These tend to be long-term policies. They're not going to tackle a current account deficit in the short run. Some of them can also be extremely expensive. So improving infrastructure, for example, will generally cost government a lot of money. We've already got a high budget deficit, so you've got to question where the funds would come from for such a policy. So overall, everyone, you've got these key 4 policies that can be used to tackle current account deficits: expenditure reducing policies, expenditure switching policies. We could look to weaken the currency, or we could look to use supply side policies. Now, a bizarre thing that we mentioned in the last video, if let's go back a couple of slides, was that current account surpluses can also technically be problematic for an economy. If you've got a huge current account surplus, it means that it's going to increase aggregate demand. High export growth would lead to export-led growth and fuel a growth in aggregate demand. That can be quite inflationary. It also means that a high proportion of an output of an economy is not going to be used to benefit people within that country in terms of consumption. It's leaving the economy and going somewhere else. A huge current account surplus can also lead to trade wars and retaliation from other countries across the world. So technically, you could argue that some economies might want to reduce a current account surplus, and that can be done by the opposite of the policies that we explored for ways of reducing a current account deficit. So, for example, you could use expenditure increasing policy. So rather than looking to reduce people's ability to buy goods and services, we'll raise it. So if we were to use expansionary fiscal policy, lower income tax rates, we're pushing more money into consumers' pockets. That allows them to buy more foreign goods and services. If we were to lower interest rates, we're reducing the cost of borrowing and we're incentivizing more consumption to take place, less savings to take place, which again leads to more spending. And that should lead to a growth in the demand for imported goods and services. What it would also do, though, it would mean that firms within an economy are less likely to look towards export markets. If you've got high domestic demand, well, you're probably going to satisfy that before foreign customers. So it means that more goods will stay in the economy to benefit domestic people. We could also use expenditure switching policies again. So what we could do, we could remove protectionism. We could remove things like tariffs and domestic subsidies, which will raise the competitiveness of foreign goods within an economy. And that would lead to more trade liberalisation and more foreign goods to flood into an economy. You could also look to strengthen your currency value. Think about it, strong pound, imports cheap, exports dear. A stronger currency would lead to imports becoming cheaper due to that improvement in the terms of trade. So more imports would flood into the country. Okay, so technically all those policies could be used to tackle a current account surplus. Right, now, just to end this presentation, I would now like you please to think about policies that can be used to improve trade performance. So I want you to now think about these 4 different policies: expenditure reducing, switching, currency devaluation, and supply side policies. I would like to write down an explanation of how this policy works, technically how it would improve trade performance, but then think about evaluation. What are some of the problems of these policies? You could be thinking about conflicts, costs, time lags. Okay, so that is the end of this video, everyone. Thank you very much.